Sales of business property, presented by Brian Julius. You can find this on chapter 7, page 20 to 26 in our books. Executive summary is about IRC 1231 assets, which are assets used in a trade or business that are held longer than 1 year. The sales treatment of 1231 assets varies depending on three main factors. If the asset was a gain or loss at the time of sale, if a gain, whether the asset can be depreciated, and whether the asset is depreciable real property like buildings or personal property like equipment. Gains and losses from the sales of 1231 assets must be netted. If a net 1231 gain results, net gain is taxed as a long-term capital gain, subject to depreciation or capture. Net 1231 gains will receive preferential tax rate treatment, and that's why they should be taken advantage of by businesses and for personal use alike. If a net 1231 loss results, the loss is treated as an ordinary loss. Ordinary loss treatment allows an unlimited loss deduction rather than the 3K limit placed on capital losses. Sale of these assets will be reported on Form 4797. The gain in a 1231 gain must be netted with other 1231 transactions. If a net 1231 gain results, then the gain is transferred to Schedule D as a long-term capital gain. If the net transactions result in a loss, though, the loss from Form 4797 is transferred to line 4 of Schedule 1 as an ordinary loss, which you can see above. Pretty simple and very beneficial if you can't categorize it as a loss, as there's no cap to the amount that you can claim for a deduction against your income. And for this depreciation recapture, which will only happen if you have a gain for 1231 asset, as seen in the graph, is an income tax deduction that permits the taxpayer to recover the cost or other basis of an asset used in a trade or business. The longer the taxpayer owns and uses the property, the more cost is recovered. Therefore, the adjusted basis will be reduced. The lower the adjusted basis, the greater the gain to be included in the taxpayer's taxable income. The taxpayer will sell this 1231 property for a gain. This gain can qualify for capital gain tax preference. The position of the IRS is that if a taxpayer was allowed to reduce taxable income through depreciation deduction, therefore paying less in taxes, then when the property is sold, some of that gain attributable to depreciation deduction should be taxed at regular rates. This is depreciation recapture. So basically, what this last statement is saying is that gain when you sell something like your property or equipment should be taxed at regular rates instead of business rates. And this recapture will be recorded as ordinary income as long as it was created by taking a deduction for depreciation. For personal property, the gain attributable to depreciation is taxed as ordinary income, whereas the gain attributable to depreciation for real property is taxed at a special rate of 25%. Also, when a 1231 asset is sold at this loss, the loss will always be treated as an ordinary loss, provided that there are no 1231 gains to offset the loss. With IRC 1245, property is personally traded is personal trade or business property subject to depreciation. The definition encompasses most assets used in a trade or business, with the exception of real property. Land, buildings, and building structural components are not included as 1245 property. Common examples of 1245 property would be machinery and equipment for business purposes. The definition also includes assets such as automobiles, livestock, and uh, very weirdly, certain buildings placed in service between 1981 and 1986. The general rule concerning 1245 recapture is that any gain recognized on the sale of 1245 property is ordinary to the extent of the depreciation taken. This gain will be treated as ordinary income, as the lesser of the depreciation taken for the realized gain. For 1231 gain in excess of the depreciation on 1245 property is unusual because equipment rarely appreciates and any gain is usually caused by the depreciation taken. Business property sales that occur during the year are netted, and these netted gains and losses are reported on the first page of the Form 4797. The new regulations on this subject were released in January 2019 by the Treasury and IRS, with the final IRC 199 regulation. It was about gains and losses as QBI. The final regulations removed the specific reference to 1231 assets and provided that any short term or long term gains or losses are not taken into account for calculating QBI. However, if the item is not treated as capital, such as Section 1245 recapture, it is included in the QBI calculations. Section 1245 recapture provision is due to depreciation taken in previous years. As depreciation deductions are made which reduce business income, the adjusted basis of the property is also adjusted. When the 1245 property is sold for a gain, to the extent any gain is from depreciation, the amount is of ordinary income is included in the calculation for QBI. Any excess gain over depreciation taken will be categorized as a capital gain. For objects under 1250, recapture will refer to the portion of capital gains from a 1250 property, presenting the tax benefit of a depreciation deduction previously taken. IRC 1250 property includes depreciable real property used in trades or businesses that has never been considered 1245 property. 1250 property includes all buildings, residential and non residential, used in a business or for the production of income. The general rule for 1250 is that any given 1250 property is considered ordinary to the extent the depreciation taken exceeds straight line depreciation. Any other gain will be classified as a 1231 gain. Few recent 1250 sales have been the subject to the 1250 recapture provisions. Most real property placed in service from 81 to 86 used accelerated depreciation methods over periods of 15, 18 to 19 years. Although it is likely that same taxpayers still own many of these buildings, recall that these properties are considered 1245 property. Most other buildings placed in service prior to 81 are likely to be fully depreciated under your straight line or whatever method used. Thus, the depreciation taken would be the same under all methods. An important aspect for 1250 property in recent years is the capital gain rate applied to the gain. The term unrecaptured refers to the amount of capital gain attributable to depreciation previously taken and is taxed at a 25% capital gain rate rather than the 0, 15, or 20% rate. The gain treated as income subject to the 25% tax is the lesser the depreciation taken, or is will be the realized gain. If this was the only sale of the 1231 asset, the remaining monetary gain due to the appreciation in value, aka the selling price minus cost basis, would qualify for the 15% rate. If there is no recapture provisions, the entire monetary gain would be taxed at 15% for the tax liability. This portion of the gain that is attributable to depreciation is taxed at 25%. Any gain in excess is considered a normal 1231 gain and is potentially taxed at the preferential rate. In conclusion, we learned that the Section 1245 ordinary gain affects the QBI calculations per Section 199A. If 1231 gain results, the net gain is taxed as a long term capital gain subject to depreciation recapture. And these net 1231 gains receive preferential tax rate treatment. If a net 1231 loss results, the loss is treated as an ordinary gain, and this ordinary loss treatment allows an unlimited loss deduction rather than the 3,000 limit placed for capital losses. And also, we learned how to depreciation recapture on uh, different classes, whether they're classified as 1231s, 1245, or 1250. Thanks for listening, and I'm excited to read your feedback.